Welcome back, members. After a detailed discussion on the audit procedures on the tax audit, now we'll have a discussion on ICDS. I request our chairman to escort the speaker onto the dais and hand him over with the floral bouquet. I welcome CA Mohan Lavi, sir. Yeah. No, it's just few liners, so I'll just finish. I take the pleasure in introducing CA Mohan R Lavi, who is a qualified chartered accountant in 1989. He has over 25 years of experience in industry across a variety of industries. He has worked in senior positions in finance and manufacturing and software companies. Mr. Mohan also has over 6 years of experience in practice. At present, he is the partner with Mrs. KP Rao and Co. Chartered Accountants, and he heads the Ind-AS and GST practices of the firm. He is also the author of books on IFRS, Ind-AS, key audit matters, and other related topics. Mr. Lavi has also spoken at various conferences in India and abroad on accounting standard, IFRS, Sarbanes-Oxley, and GST. And he is also a regular faculty member with the Institute for their IFRS certification course and registered valuer programs. His articles appear frequently in the Hindu Business Line, Deccan Herald, and Bombay Chartered Accountants Journal. With this brief introduction, I welcome you again, sir, and I present to you.
Freebies which everybody is filing, and there's a huge amount of data analytics which goes around the GST department. The fact is that they have a lot of information. What is beneficial to assess is that they do not know what to do with that information. One of those bits of information is clause 44. All you're going to do is give them this information. I do not know what they are going to do with that information, whether now or in the future, whether, as sir said, whether they're going to only take up the URD purchases, how are they going to pick it up? We do not know. But what we can probably be sure of is we'll get some very interesting notices. That is taken for granted. That is guaranteed for us because the notices will keep coming based on what we have filed or whatever data they are processing. So that is my 2 bits on clause 44. Disclaimer, as sir said, is always better because we should not forget the fact that we are certifying the tax audit report. We are certifying the tax audit report. So I would still also prefer that a disclaimer is given for the tax audit report. As far as ICDS is concerned, I have always been calling it as increasing confusion, decreasing simplicity. And Guru Acharya sir, and I think in some conference also mentioned this as confusion and distortion. In one of his past presentations, I saw he's called it as confusion and distortion. I'm not going to get into why ICDS is there, should it be there. That and all will take probably the end. But my thinking has always been that when you have got a detailed income tax act and you have got an equally detailed tax audit report, why do you require ICTs? When you've got the income tax act, you've got accounting standards, you've got tax audit report, whether it's really required or not is a question I'm going to leave open-ended. In my mind, it is a glass half full and half empty because they've not really covered all the standards in this. And there can be complications in ICDS, especially for an NDAS company. For an AS company, yeah, maybe you can just get away with what has been mentioned in the ICDS, but for an NDAS company, there could be some issues there. So there is a move. Why is it not moving? Yeah. Hearing, is it? Okay. So this was brought in to amendment to 145 through a notification, as all of you are probably aware, 2017-18. ICDS has been in the works for a very long time. It was previously drafted as tax accounting standards, then amended, then again revised, not introduced. Finally, what we are seeing today is the final version of these ICDS. There's a body called as the Chamber of Tax Consultants. This Chamber of Tax Consultants has got a reputation for always filing cases about the constitutional validity of any new law that comes in. When service tax came in, they said, we are paying profession tax, so why do you require service tax? When ICDS, just drop it. It's just only a distraction, that's all. When ICDS came and they said constitutional validity because it is against accounting standards, why do you require ICDS? Actually, Delhi High Court favored them. They said, yes, we don't require ICDS. But then the Finance Act, they have got this Brahmastra, retrospective amendment. They used the Finance Act, retrospective amendment, and said that it is applicable here. So the Delhi High Court decision was basically struck down, saying that it is not required. What we are talking about in tax audit are only 3 clauses. Actually, 1 clause, 3 subdivisions. 13D, which talks about the fact whether any adjustments need to be made as per ICDS. There is a tabular format to be given for these disclosures. And 13F is what are the disclosures required for the ICDS standard itself. Now these, as all of you are probably aware by this time, requires no repetition, are the 10 ICDS standards notified long back, still remaining on the statute book. No amendments, no new standards, no clarifications on these standards also. For each of these, you will have an equivalent AS and probably an equivalent Ind AS also. If you dig deep, you'll probably get an equivalent Ind AS standard also for this. But there are a couple of things which I thought I should probably tell you all. Forgive me for this little bit of a sweating. It's only because of some medicines, so it should be okay for after some time. You look at the revenue part, completely covered. Completely covered. Revenue, you got construction contracts, you got revenue. Revenue side is completely covered. Look at the expenses side, partly covered. You don't have ICDS for all the expenditure standards. Maybe out of omission, maybe out of oversight, maybe on purpose, we do not know. But the fact remains that these standards have been basically based on AS. We should not forget the fact that Ind AS is becoming, I won't say the rule, but many companies are moving towards Ind AS for whatever reason it is, by law or by requirement, or even the AS is being amended now. And as I said earlier, there's been absolutely no effort to amend these ICDSs for taking into account, amendments in accounting standards. AS 10 itself has been revised subsequently, no equivalent change in the ICDS standard. So it has just been there for the purpose of this thing here. If you look at what they do not have ICDSs for, employee benefits, revised revenue standard, leases, all the share-based payments, financial instruments, pretty complex under Ind AS, but even for AS 109 draft is out there. We do not have a equivalent ICDS for these revenue or the debit side of the P&L account, or for the basically for the expenses side. What does this imply for us? This implies that if I take a very simple concept of transfer of significant risk and rewards for revenue recognition, which is something which all of us are, pretty familiar with, I do not see a problem between ICDS and IND-AS, and AS also for that matter. For the purpose of today's discussion, I'll forget about IND-AS. I'll just talk about IND-AS in brief because there could be a lot of complications in IND-AS. So for that concept of transfer of significant risk and rewards, we may not have much of a problem because that it's an event-based transaction. We know what is going to happen. It depends on the contract and all those things. That would pretty much remain the same in ICDS also. But I look at my P&L account on the debit side, there are going to be situations wherein there is no equivalent ICDS. The saving grace for us is that the ICDS standard says that when there is no equivalent ICDS, please fall back upon the Income Tax Act, not any other accounting standard. Please fall back upon the Income Tax Act. And when we are saying Income Tax Act, I am probably thinking of this beautiful section called 37(1). For my expenditure side, I will only take protection under 37(1), not under any other clause because of the absence or lack of a specific ICDS or an accounting standard also for that. Of course, for the companies and any of your clients who are done IND-AS, the complications become a little bit more. But as I said, I'll not focus too much on that today because it requires a more detailed session, not possible in 1 hour at least. The ICDS once spoke about disclosure of accounting policies. And they are saying that the mark-to-market losses, or what is called as MTM losses, shall be recognized or allowable as an expenditure only upon actual settlement. Notional losses will not be allowed as per ICDS. There have been a lot of cases in income tax wherein courts have held that both ways. Some have held that it is allowable as a debit to the P&L account. Some have held that no, it is only on actual settlement. ICDS sort of settles that issue and says that. So basically what they're trying to say here is that if you have a notional gain or a loss, I'm going to talk both ways, both gain or loss. For the purpose of ICDS, it will not be either offered for taxation or even permitted as a deduction. Premium, discount, exchange also difference. They're talking about the same situation wherein it has to be on a settlementally. Because ICDS 1 talks about accounting policies, they have put in a small sentence saying that accounting policy shall not be changed without reasonable cause. What is reasonable cause? Or rather, when will you change an accounting standard? It is not an accounting policy. When will you change an accounting policy? Normally, it is when it is driven by a statute. You don't have so many options. Normally, when a statute mandates, that's when you will change an accounting policy. AS to IND-AS, IND-AS to some other accounting policy, or within the standard itself, some changes. It will normally be driven by a statute. But here they are saying that without reasonable cause, it's not clause, it's cause. You should have a reason for changing. Mandate by statute can be a reason. Voluntarily, you cannot change. That's what they're trying to say here. ICDS 2, I'm going to go a little bit standard by standard. So in case there are any specific questions, we'll take it up later on. Standard cost has been omitted as a method of valuing inventory in ICDS. Weighted average cost is there. Other cost methods are there. Standard cost is not permitted, which means any entity which is doing standard cost method of valuing inventory would have to change or disclose the change as against the AS versus their what is the normal method which they are following. If you are doing a standard cost, it will be you have to go back and give the difference in your tax audit report as saying that this is what we are doing for AS and this is what we are going to do for the ICDS. It will not be allowed there. So that method of working would have to come in that clause 13D itself. It will have to come in there. They will, yeah. The impact may not be there, that's what. The impact may not be there. There may not be an impact for that. The pricing they'll change, obviously, correct. Similarly, the change in method of inventory. This is a very favorite topic for all the assessing officers. Change in method of inventory shall not be made without reasonable cause. We should remember that in your various cost methods permitted in AS2, you have an option to change. You have an option to change. You can go, for example, from a standard cost to a weighted average cost, or you can go to a cost for each specific item of inventory. There are some companies have what is called a specific cost, in which they put a specific cost to each item of inventory, depending on how they branch out the inventory. But here again, they are saying it cannot be done without reasonable cause. This is sort of putting a little bit of more power on the assessing officer to choose and saying that you do not have a proper cause for change of inventory. But then ICDS, I do not know who has drafted the ICDS. They have done one good thing. They have attempted to explain what is reasonable cause. I'm only saying attempt to explain, because I'm going to put it up in front of you and ask you all to interpret this. What is reasonable cause? They have said that reasonable cause is an existing concept. It has evolved well over a period of time, conferring desired flexibility to the taxpayer in deserving cases. I do not know what this means. But I am only going to focus on that one word called as desired flexibility. When any tax officer asks me any question on why have you changed your costing method, sir, reasonable cause, sir, desired flexibility. Nobody has told us what this desired flexibility is. Yes, it has impacted my P&L account, opening stock, closing stock, all that I'm going to adjust, no doubt about it at all. But I'm surprised that a standard or a set of standards which are so small in nature have decided to give an explanation for reasonable cause also. So actually, if you ask me, this works in our favor. It has not told that, it has not given words like statute, regulation, and all those things. It just said desired flexibility or evolved over a period of time. Now, you all may want to go for case laws. You all may want to go for support of case laws. Karnataka High Court has got a bunch of case laws for reasonable cause. But normally, most of these case laws, what has come out very clearly is that there has been an intent to actually change the method of accounting because of a particular requirement. Again, driven by statute, driven by business exigencies. Driven by business exigencies. Also, you want to change your accounting policy because now you can, many companies now, after this impact of COVID, they may probably want to change their method of accounting for a certain amount of their stocks because they feel that, it's not worth what it was previously. So please use this as a defense in your nature. Construction contracts. Somebody was asking a question about construction contracts and the information given in tax audit report. One of the most dangerous clauses in ICDS is that retention money is also going to be taxable. Retention money also will be taxable under ICDS 3. Retention money will come as a deposit or it will be shown as a financial asset or a liability in my books of account. ICDS is going to tax it. Very clear intention in your very clear language in ICDS 3 saying that retention money will be taxable. How are we going to make out retention money is there or not? If you call it retention money, there is no escape. If you call it some other money, I won't call it some other money, but yeah, deposit, whatever it may be, withholding, use some complicated words, maybe you may not actually come under this because if you look at it in terms of actual business perspective, retention money I will not get till the project has been completed. This is not my income till that completion has happened. This is a very clear thing, but ICDS wants to tax it, so we'll have to be a little bit careful what we do here. Similarly, for construction contracts, many construction contracts can enter into a loss. A7 permits recognition of losses if you have a clear, idea that this is what is going to be the loss for this. But here, again, ICDS says, actually incurred, which means you will have to wait for the project to be completed to draw up a project P&L account and allow for those losses. Income is being taxed in advance, losses are being deferred. So that seems to be the idea behind ICDS. But they have also spent some time to do a little bit of work. A7, as all of you all are probably aware, A7 talks about the percentage of completion method and also gives an option for the completed contract method in certain cases. One of the I won't say deficiencies, but one of the issues in AS7 was that it did not tell us when do we commence the POC method. It just said POC method. So do I do the POC method from the start of the project? Maybe no. Because if I look at a project which is a real estate project or a construction contract, it may take 2-3 years time. When do I commence POC method? In case I'm opting for the POC method, when do I commence it? No guidance given in AS7, example also not mentioned it. What the ICA did was, they brought out a very good document which is called as Guidance Note on Real Estate Transactions, in which they have given some benchmarks. When do you commence your POC method? 25% of the construction should have happened. 10% of revenue should have been realized or should have been booked. At that point of time, you commence your POC method. Till then, cost is equal to revenues. No profit is recognizable. What ICDS has done, taken that guidance note and said, POC method you commence only when you complete 25% of construction. So up to 25% of construction, you will have to do cost is equal to revenues, no profit element is involved. So they have taken bits and pieces from everywhere. Once you commence the POC method, obviously till project completion, you will have to continue the POC method only. So that is not a problem as far as the ICDS also is concerned. You've got a lot of flexibility there. ICDS 4 on revenue recognition, please look at the first two clauses. Revenue recognition to be postponed if significant uncertainty exists on collection. This is what the AS is saying. Revenue to be recognized only if there is reasonable certainty of its ultimate collection from sale of goods and rendering services, what ICDS is saying. Do both mean the same thing? For all practical purposes, yes. Both mean the same thing. The focus on AS9 as well as ICDS 4 seems to be on ultimate collection, which means that I should be reasonably sure, or let me use the word saying that reasonable certainty only, which is used in ICDS, because we are talking about ICDS only. There should be a reasonable certainty that I will realize the money. Only then recognition of revenue can be permitted in ICDS, which puts us in a little bit of a spot, because what will happen from a provision for bad and doubtful debts? If I create a provision for bad and doubtful debts for a set of customers, and those customers I'm recognizing revenue here also, probably the department can come up and say that there is no reasonable certainty. Because you've made a provision in the past, you will not be able to recognize revenue for that. But I think department, as far as the revenue side is concerned, they are very comfortable. So I don't think they'll come to that sort of a situation. But these clauses read in tandem will definitely ensure that I think there's not much of a difference between your AS9 and ICDS 4, at least in terms of this thing, provided that reasonable certainty is that you have to be a bit careful about your bad and doubtful debts. Any of you who got Ind AS clients and 115 is applied, which is mandatory, you're going to have a lot of problem in ICDS. Because Ind AS 115 is completely different from AS9. Significantly different. They've got so many clauses there. They've got something called as performance obligation, variable consideration, estimate, significant financing component. If any of your clients are following Ind AS 115, you're going to have a problem in the ICDS, because what ICDS is going to talk about is simple concept of uncertainty on collection, whereas Ind AS says go back to an ECL model for your bad and doubtful debts. So there is going to be a lot of difference between your. So I think, to my mind, one of the most impacted areas in Ind AS versus ICDS would be in your Ind AS 115 versus your ICDS 4 and revenue recognition, because whatever performance obligations you're trying to do there is going to be a problem. I will not, delve too much into specific issues and all, but it so happened that in one of the sessions, there were people, we had to train people from the income tax department also on Ind AS. And normally I'm very hesitant to talk to department officers on, Ind AS standards. When the expenditure side was spoken about, they sort of pretty much got it. They said, okay, fine, no problem. But Ind AS 115, they were completely not comfortable. I couldn't make out. There was a very clear resistance to Ind AS 115. Because whatever we are trying to talk about, saying you want to postpone the revenue, show it as deferred revenue, expected consideration, most expected value, they were just not comfortable with it at all. It so happened that during the session or after that session, one of those officers came up and told me that when I'm doing Ind AS assessments, if there's any doubt, can I call you? So talking to them itself, normally I refuse, but when he's openly asking me this, I had no option but to say, sure, sir, anytime you can call me. So he happened to call me sometime last year and said, I'm doing this Ind AS assessment of this company. And I'm finding in your cash and cash equivalents, I'm finding something called as foreign currency non-resident balances. I told him, please ask the question. He said, is it not income? He asked me. I told him, sir, this is a balance sheet item. So it means the cash has been realized. It is in the bank account. Maybe it's a foreign customer. Sale has already been recognized. Receivable is there. That money is probably in the bank account. So you may not be able to tax it because it's a balance sheet item. His next question sort of surprised me even more. He said, okay, I agree with you. Can I tax 50%? Okay, what do you call it as a bargain, whatever it may be. But the point is that conceptually, this is very, very different. India is very, so the fact remains that there are going to be a lot of issues in 115, and there's going to be a lot of assessment problems also in India's 115. As far as the fixed assets is concerned, I think by now pretty much we are clear as to what is going to happen here. See, one of the things I should remember is that AS 10, which has been revised, is almost as per Ind AS now. Small differences in disclosure, that's all. Standby equipment and spare parts, if they are going to be used for more than 1 year, they have to be capitalized. Revised AS 10, Ind AS 16. And here also they are saying that, of course, AS 10 says may capitalize, ICDS says shall capitalize. Which means if you look at a repairs and maintenance breakdown, and you look at some of those spare parts more than 1 year, as per ICDS 5, you will have to capitalize it. As per AS, it may have gone as an expenditure. Because we should not also forget that the concept of materiality, which many companies use, has not been spoken about at all in ICDS. In the sense, I may have a different threshold for materiality for my AS standards, but may not apply it in my ICDS. So if I'm doing a debit to the P&L account as repairs and maintenance only because of the concept of materiality, capitalizing under ICDS, you could have again a small difference there. Again, these words are very specific in the ICDS, so I don't think we should really dispute those words. So if you've got any spare parts, standby machinery, more than 1 year, the useful life should be more than 1 year, compulsorily you'll have to capitalize as per ICDS. In AS, you may have an option of expensing it out. So that could be one of the main differences there. Foreign exchange differences. One of the most interesting paragraphs, AS 11, was para 46 and 46A. It was initially 46. When the extension came, they made it 46A. This basically talks about the foreign exchange differences arising because of long-term currency, foreign currency monetary items. Say, for example, you have taken a loan from a foreign bank for a fixed asset. Those exchange differences can be capitalized as per this section 46 and 46A, you need not capitalize. You can also put it to a foreign currency translation difference account, FCMTD account or whatever it is called. This FCMTD account is not there in ICDS. So companies who are following para 46 and 46A have transferred it to a reserve, will not be able to transfer to reserve in ICDS because ICDS says, you look at 43AA of the Income Tax Act, they are saying it will have to be adjusted to the cost of the fixed asset. So specific items of foreign currency borrowings which have been capitalized as per your AS 11 para 46 and 46A, whichever paragraph you are using, when you do that same, apply that same exchange rate or the difference to ICDS, it will definitely have to be part of your reduction from your fixed assets. Therefore, your depreciation can also get impacted. So like this, what has happened is that I spoke earlier about mark-to-market losses, also spoke about this foreign currency differences which are coming in because of the, until they are realized here. Because basically, if you look at it from a accounting standard point of view, why is that foreign currency translation reserve account there? Why is that option there? That option is there because this is actually a notional gain or a loss or an expenditure. I'm not realizing this. This is only basically because of exchange difference only. But here, because of 43AA of that, mandatorily it has to be reduced from the asset there. Okay, as far as the Ppe grants are concerned, again, they are very specific. It has to be reduced in the value of the property, plant and equipment only. You cannot show this deferred income in ICDS. See, this is a area where, especially in PSUs, you may have some problems. See, basically government grants, government doesn't give everybody a grant. It goes only to specific companies. Accounting standards are pretty clear. Look at the purpose of the grant. Look at the grant period. If the grant is for a fixed asset, adjust to the cost of fixed asset. If the grant is for expenditure, over the grant period, you will show it as revenue. So accounting standards are pretty clear. Even if you look at Ind AS also, I think it's pretty clear as far as that is concerned. But here they are saying that Ppe grants to be reduced in the value of Ppe, income cannot be deferred. This ICDS requires a correction definitely. Because I will give you this very interesting case. Of course, now different company, but ITI Limited in Bangalore, when they were in their last few days, or last few years, they were surviving in government grants. Because who uses, those landline telephones nowadays? Everybody is now on the mobile, right? So they were almost under the verge of bankruptcy or insolvency or dissolution, whatever we may call. And they applied to the government for a grant of about 1,000 crores. Because they said, we want to survive for some more time and we'll try to do some other plan for capital expenditure. We'll try to change the phones and whatever they tried. So the government gave them a grant of 1,000 crores. What was the purpose of the grant? Because every grant letter should mention a purpose. What was the purpose of the grant? Purpose of the grant was for improvement of balance sheet. Now this person brought the grant letter, bought this 1,000 crores. And if you looked at ICDS, now they'll say no deferral, 1,000 crores income in 1 year. 1,000 crores income in 1 year means 30% income tax. Net grant is how much? 700 crores. So no improvement is possible in the balance sheet. The C&G also caught on and said, no, you'll have to show it as income only because there's no deferral permitted also. But then I looked at this became an accounting issue also. And I looked at the balance sheet of ITI. At that point of time, I could make out what the government was thinking. They had about 990 crores worth of loans on their balance sheet. So what was the government thinking? Repay all your loans, your balance sheet will improve. So how long would it take to improve the balance sheet? Half an hour. Take the 1,000 crores, repay your loan, balance sheet is improved. Over half an hour, that's all it takes. But then we got into a long debate with the CA also told them that improvement of balance sheet does not mean only repayment of loans. We have to pay salaries. We have to do printing and stationery. We have to do so much of expenditure. So please give us 3 years time to show this improvement in balance sheet, and we will defer this revenue over 3 years. CA were sticklers for documentation. They said, I have no problem. I agree with what you're saying. But please change the grant letter and come. The grant letter should say, please improve your balance sheet over 3 years. So this ITA person again went to Delhi. And that's their small request is that please add one sentence here. Please improve your balance sheet over 3 years. The person came back, sealed cover was there, grant letter was opened. The grant letter said, please improve your balance sheet over 30 years. ITA was very happy. 1000 divided by 30 means no problem at all for them. They told the CNHS, you wanted a letter, we got a letter. Now what do we do? Then CNHS said, no, 30 years not how year. We don't know if CNHS will be there or not at all. It's not possible. So again, go and change it to 3 years. This person said, I'm not sending anybody. I think it became 300 days after that. Who's going to look at that? That was the only time wherein this whitener worked very well. Normally we see how whitener works. That was the only time the whitener worked very well there. Perfectly it worked and said, okay, fine, keep that as a document, do it over 3 years. Again here, that's why I said this will have to be changed because many grants are given for, see, normally what happens in many companies, they give grant for reimbursement of salaries, which is absolutely fine. I pay salary this month, I get a grant for this month. That's okay. But grants which are over a period of time, like for these specific purposes, in those cases, I may have a problem in ICDS because the concept of deferred income is not there at all. I will have to wait for the grant. If the grant is received in advance, all the more problematical for me. So they may have to change this ICDS to permit in case of grants wherein the grant period is more than 1 year to probably show it as deferred income over that period of time. No guidance on grant in nature of promoters competition, fine. AS 13 versus ICDS 8 on this securities, there's a lot of differences. Now, all of you are practicing would have had experiences. Financial instruments are there in every company's financial statements. This is only talking about all these securities held as stock in trade. There is no mention of what to do with my investments. Okay, even if I'm assuming fair value as my concept for investments, because I got a market value, I got a quoted market price, all those things also. There are a lot of, the ICDS 8, there could be a lot of differences because if I'm not holding it as my stock in trade, what do I do for it? Okay, Income Tax Act says, okay, you got fair valuation as a principle there, I'll do it at fair value, offer it for taxation, no problem. Because ICDS says when you are in doubt, always fall back upon the Income Tax Act. But my problem is not referring back to the Income Tax Act. My problem is that in my ICDS itself, I've got a very restricted scope on this. It does not talk about investments made by a company in the nature of investments. It only talks about things that have been held as stock in trade. Here also, again, if you are having a client who's Ind AS, you're going to have a lot of problems because Ind AS talks about something called as business model. Here, there's nothing about business model. There is no model at all here. It's only talking about what is there as stock in trade here. Financial instruments, any investments which are held in the nature of investments, please be a little bit careful because ICDS is talking about what is being held as stock in trade. You could have a different policy in your accounting standards. AS 13 also. You could have a different policy as your AS 13 is concerned. Because of the fact that income tax talks about, the Income Tax Act talks about fair value, we can probably get away. But in your ICDS disclosure and tax audit report, you may have to mention that we have drawn upon reference upon the Income Tax Act and not a specific ICDS because the scope limitation is there in ICDS here. Okay, borrowing cost, exchange differences are not there in ICDS. That's okay because they always talk about realized gains and losses only. They have spoken about something called as pro rata borrowing cost, ICDS. See, one of the problems in ICDS also, which I have seen, and all of us, whenever we read a new regulation, whenever we read a new accounting standard, whenever we need a new, even if it's a new legislation also, we always look for an example. ICDS has used something called as pro rata borrowing cost. I do not know what that means now. I am assuming that what they are trying to say is that if you've got a general borrowing, do it on the basis of total pro rata basis, total amount of loan into pro rata basis, that's what you do. But is this what they are trying to mean? No specific examples in ICDS. So again, it could give a little bit more power to the assessing officer to decide what could be the possible pro rata borrowing cost. ICDS 10, provisions, contingent liabilities and contingent liability assets. The only thing which is common in between AS 29 and ICDS 10 is the title of the accounting standard. Only title is the same. After that, everything becomes different. We should remember that AS 29 came in when Ind AS was almost requirement in Indian context. So all these provisions are almost the same. See, if you look at it from a very simple accounting standard point of view, current obligation from past event. If the amount is certain, it's a liability. If the amount is not certain, it's a provision. Current obligation from past event, if the amount is certain, it's a liability. Amount is uncertain, it's a provision. Possible obligation from past event is a contingent liability. You don't account for it, you only disclose it. This is exactly been done as per in ICDS 10 also. Exactly the same things have been used there. Only problem is that subsequently, when the discussion happened about what is the past event, what is the obligation, and this thing called as onerous contracts. Onerous contracts, even there in AS 29, but not permitted in ICDS because it's out of the scope. Onerous contracts are contracts in which the costs of the contract exceed the expected revenue at the beginning of the contract itself. You know that it is going to exceed your revenue, and during the course of the contract, you know that it's going to exceed your revenue. At whatever stage this onerous contract costs exceed benefit, AS 29 says that loss, estimated loss, you please recognize. Obviously, loss means ICDS is not going to permit it. They're going to talk about incurred loss only here. But again, what is this incurred loss? Maybe at the end of the contract, if you're doing a project-wise accounting, at that point of time, maybe you can say, okay, my total losses. Many of you would have heard of the word called onerous contract. I'll give you an example for an onerous contract. This company called as Lanco Infratech. They were building, they wanted to help the residents of Hyderabad city. So they said, we'll bring water from Nagarjuna Sagar Dam, which is about 250-300 kilometers away from Hyderabad. So a big pipeline will draw water and come bring it to Hyderabad city. It is called as Krishna Stage 2 project. They told the government of AP at the time, there's only one state, that total cost is about 25 crores. No profit, only we are doing it for social cause, 25 crores. So the AP government gave an order saying, okay, 25 crores, build the pipeline. These people started building the pipeline. What was the value of the pipeline? 25 crores. Now, as they were building the pipeline, somewhere in the middle, they suddenly realized that they got an obstacle. What was the obstacle? There was a huge hill there in front. When the hill is there, where will the pipeline go? They can't go above the hill because water will fall down again. They can't break the hill because hill is not theirs. So what they did was, they had to build the pipeline around the hill. Another 40 kilometers. Another 40 kilometers is what again? Increase in cost. They went back to the AP government and said that the small problem has cropped up there. Project cost is 25 crores. Now we have to build this, we have to take the pipeline around this hill. It cost another 4.5 or 5 crores. AP government said, no, nothing doing. You agreed for, hill was there before also. You didn't come up when you're building the pipeline. Nothing doing, 25 crores only. I cannot go back and get an order for this. It's yours. This is an example of an onerous contract because what is the revenue here? 25 crores. What is the expenditure here? 29.5 crores, or what are they going to actually incur here? You look at that from an AS 29 point of view. when they were certain that they're not going to get that 4.5 crores, they can recognize the loss. But from ICDS point of view, they will have to wait for the, I do not know what, completion certificate, wait for the entire pipeline to be given, whatever it may be. Only on that event-based transaction can they recognize the losses. So, and many people have got this habit of summarizing ICDS by saying that income is recognized in advance, expenditure is deferred. To a large extent, probably it's true, because they are not permitting deferral of revenue, but they are taxing the revenue in advance. But they are also not doing this, permitting this expenditure, which is going to be done on a whatever the basis of the expenditure, not allowing those losses to be recognized till they are actually realized. So these could also be an area wherein AS 29 can also be a factor wherein you could have a problem there. The concept of discounting, very common in Ind AS, also common in a certain revised ASs, is not there in ICDS at all. So nowadays in this faceless, nameless era, how are you going to convince the officer that discounting has happened because of an accounting standard? ICDS does not use the word discounting at all. So if you are doing any discounting there, whether it is ICDS or Income Tax Act also, you're going to have problems because the word discounting is not being used at all. I've just given a small example of what could be the possible disclosure in 3CT here. Now, just to tell you all about this, because the examples I have given or the differences I have given are obviously entity specific. Entity specific means what is applicable to your client, that only you have to throw up a difference for. You don't have to do the entire thing unless it is the same. But very commonly, you will have a difference, could be possible in inventory. Out of those 10 ICDSs, you could possibly have a difference in inventory because companies, they can use a specific measure of inventory. If you are following AS9, you may not have too much of differences with ICDS if you're following AS9. But again, for Ind AS, it's going to be a different issue altogether. Forex differences and government grants, you could have a difference there also because of the fact that government grants, again, I told you there's a possible weakness in the standard wherein you don't have a deferred revenue concept there. You may have to convince the officer that there's reason for your difference, because personally, I do not see ICDS being amended at any point of time in the future. They've forgotten about it. It's over. There was a draft ICDS on leases which came out. That also is a draft stage only. So we're probably going to live with these 10 ICDS at least for the next few years. I do not know how long we're going to do this. I've also sent the presentation to the Bangalore branch, so you can probably look at the presentation also. Here, it's very interesting what has happened. 13D is talking about, are there differences? 13E is saying that tabulate those differences. 13F is saying that disclose your ICDS accounting policies. If you look at what has happened, it's not visible possibly to all who are at the back there. I am drawing a reference to my accounting policies in my notes and accounts, in my financial statements. I've got specific things here wherein you've got, say, for example, look at para this of the schedule of notes and financial statements. If you look at the cost here, I said cost is on a specific, identification basis. I've used a standard cost has not been used as a measurement here. So what they're wanting us to do here in this 13F is, there are two things you should do here. If you have got a specific ICDS being followed, for the purpose of ICDS, refer to that here. Tell what you've been doing here. If not, if I'm going back to the accounting standard, give a reference to which note is there in the accounting standard or which paragraph number of the accounting policy is there. There's a third possibility here. You may not have a specific accounting standard. You may not have used the ICDS. You are going up on the provision of the Income Tax Act, because ICDS also gives that as an option. If you are falling upon, say, for example, 43AA, wherein you're going to capitalize the foreign exchange differences, that also please specifically mention in the tax audit report, saying that we have used 43AA of the Income Tax Act for the purpose of recognizing your foreign exchange gains and losses. One of the things which has probably not there as a part of this presentation also is the fact that whenever you're doing your ICDS versus your income tax books or even income tax act or book profits, please maintain a reconciliation statement. This is something which is not specifically mentioned, but I would advise all of you to keep a reconciliation statement because of the fact that how a particular treatment has taken place in your tax audit report, vis-a-vis your accounting standards, vis-a-vis income tax act, probably past assessments also, is very important. So please maintain a small reconciliation statement wherein you have specifically mentioned what you have done as per these, either the AS or the Ind AS, or also how it has been treated in your ICDS and ultimately in your computation of income also. That is very important. See, for example, provisions I have mentioned that the assessee does not have any provision which requires disclosure under ICDS 10 because you don't have any specific provision there. That's what they're trying to mention here. There could be, see, because basically what you're doing in 13E is that you're tabulating the differences. When you're tabulating the differences, you know which ICDS, what difference is there. So in this 13F, you only need to give a reference to which is your accounting policies there, which accounting policy you followed there. Okay. Before we take questions, the future of ICDS, I only put 2 question marks. I do not know. Because of a couple of things. You look at changes to the Income Tax Act, which have happened over the last 2 years or 3 years. Quite a few have happened. Many of these changes also impacting accounting profit. ICDS not amended. I would have thought so. I would have thought that you should probably change the ICDS also or amend the ICDS also. Nothing. Absolute silence in that particular point. Okay, so I'm not going to, sort of hazard a guess as what is going to happen in ICDS in the future. But if at all they have to amend the ICDS, they will have to amend it as per maybe taking both Ind AS and AS into consideration. I only hope that they don't bring out separate ICDS for Ind AS and separate for AS. That will only add to the confusion, which you already have enough as we are speaking today. Already there's enough of confusion. But I think one of the reasons why they're not doing it is because they don't want to do anything about it. Just keep quiet and keep this whatever has been put here. You say, for example, leases. We are doing something called a right of use asset in Ind AS and showing depreciation. Okay, in a computation, I'm going to remove it. There are a lot of such conceptual changes which ICDS is not capturing. The reason for that, I do not want to, even get into the reason for that because many people have actually said that even the AS has not been revised. Actually, that is not a correct statement because AS is being revised. It has not been notified, that's all. ICA has brought out something called as AS revised. Even in the draft form, it is there. Lot of AS have been revised, at least to bring it almost on par with your Ind AS, if not exactly as per Ind AS. But I see no, what you can say, effort here in this particular ICDS direction. So, to my mind, this is going to remain like this. I don't think this is going to change. Maybe suddenly somebody may come and introduce some new ICDS and try to put this into. It's okay. The final point is, I've already answered this question. Do we need ICDS? I can take an audience poll now and say, how many of you feel ICDS is not required? Can raise your hands. Most of you are, right? How many of you feel ICDS is required? Can also raise their hands. I have to be fair to both sides. Nobody has raised their hands. So I think the answer is pretty clear. This has only added to the compliance work we are doing. And as chartered accountants in practice, all of you are probably very well aware by now that compliance is creating a burden. It's no longer an ease. Compliance is becoming a burden. Every single day we are getting something new, which is happening. We are forced to do some compliance with the other. So in the middle of all this, Do I require to go to these 10 standards and see what they are saying, what they are not saying, what AS is saying, what income tax it is saying? Why I should look into all these things and look at specific provisions there? So I don't think this is required. Will it be cancelled? That also will not happen. Will it be retracted through a notification? That also is not going to happen. So this is basically what I wanted to tell. Just a couple of things which all of you all should probably remember is that in some cases we have got situations wherein ICDS in the previous year has not been noted. No, I mean, you have not shown the difference in the previous year, but suddenly this year you found out the difference. And said, sir, what do I do? Last year also, should I revise the return? Silence is the best. Do it from the current period. Don't look at the past periods, because you start past periods, you'll get into an endless loop where you want to go, how you want to go. Nobody knows about it, right? So many of these conceptual situations which we have, because of the fact that, we always have this, what you can possibly call as protection under 37 bracket 1 of the Income Tax Act. I'll leave you all with one very good case law, which happened, So there was a company in Bombay. The MD had gone abroad for business visit. Unfortunately, he fell sick there. He had to be hospitalized. Almost 30 days, 35 days, he had to be hospitalized. And it was not a normal or good, not a simple thing. So he had to be there for a long time. So the company, in all their fairness, said that it's not, fair for us to just keep the MD there alone. They sent his wife also and told her, you go and be with him and come back. Expenditure of the wife was debited to the pay and account, saying 37 bracket 1. If MD does not come back, wife also will not come back, obviously. But business will not happen. So they said 37 bracket 1, wholly and exclusively for the purpose of business. If you were the assessing officer, what would you all do? Allow it or not? 50% of the wife's travel or total travel? 50% of the wife's travel. That, I think this was Bharat Forge, if I'm not wrong, or some other company, such company. They argued before the tribunal saying that you look at the cause, look at the reason why. Normally, I don't send the wife abroad. I normally send we have sent in a specific because it's an emergency. And therefore, wholly and exclusively for the purpose of business. Now, the tribal did not know what to do. They would have probably taken saying 50%. They did not know what to do. So they kept on insisting that actually this happened at the assessing officer level. How do I know that she has spent only a time in business only? So what do you want me to prove? Date of admission was this date. Date of discharge was this date. The day he was discharged, we brought them back to India. Both came back to India. What else you require beyond this? What? Time sheets of time spent in the hospital. Okay. Thankfully, they didn't ask for that at least. So the tribunal, the Bombay tribunal, gave a very interesting judgment. They said that whatever the company is saying, all that is fine and all. They said, what is the meaning of this word called wholly and exclusive of the nature of business? Whom have these people sent? They have only sent people who are related to the person in charge. So this ad hoc, disallowance of 50%, 100%, it doesn't make any sense. They have convinced you that it is for a specific business purpose. Therefore, it has to be completely allowed. You will find such beautiful, case laws. I think this was on two issues. One was the wife going abroad. The second was they had put a very good decorated lawn in front of their factory. Interior decoration for a lawn. Asking us, said, why do you require a lawn? Or why do you want to spend money on a lawn? The company told them that, look at our customer list. 90% foreign customers. When they come, they should see something attractive. They should not see slums and Bombay and all. They should see something really good. In order to entice them and get more business, and we develop this lawn. What is the amount of expenditure? 5 crores. Not a small sum of money. That must be some really good lawn. What they did was they put an Excel sheet in which they said, what is the total amount spent on loan, amount of revenue received? Both are growing. So the fellow said, yes, perfect, allow it, no problem, for the purpose of business. What happens because of these cases, you may not have a specific ICDS, so therefore you have to be a little bit careful for follow up on these case laws. Okay, with that I can take any questions, or if all of you are hungry, you can break for lunch, whatever. Pramod, over to you. Thank you very much. Thank you. Yeah. Online, huh?
Yes, sir.
That's the integrity.
So can you explain what should be the disclosure for the ICDS in the tax audit report? And I think does he means there's one more question below this. Sir, kindly share the standard disclosure to be given in the audit report with respect to each clause of ICDS.
So, okay, the first part of the question I can answer since that's already there in my presentation. That's there at the Bangalore branch. The second part, I would prefer not to give it because I know exactly what is going to happen. What is applicable to my client will probably come in your tax audit report. I don't want that to happen. So, you can use it as a basis, but I can tell you one thing, the Bombay Chartered Accountant Journal has got one such template. The BCG has got some template available online also. I think you can probably look at that. I think that will give you a good idea, but please don't use ours or anybody else's. Choose what is specific to your client.
Under percentage of completion method basis of civil work contracts, if the percentage of completion is more than 25%, how to reconcile the difference between AS and ICDS and how to present the difference in computation of taxable income?
Okay, so actually the POC is more than 25%. There will be no difference between AS7 and ICDS. It will be the same. Your problem will come before that. Your problem will come before that because before 25%, you're not going to recognize any revenue at all. The standard says you should do revenue versus cost should be the same. ICDS does not say that. So your problem is going to happen before 25%, not after.
So that should we also answer of that second question, how to solve the problem rather than getting a question
Sorry?
of that. I mean, before 25%, should we
Huh.
go ahead and
So
clarify?
before 25%, as per AS7, you'll do cost is equal to revenue without any profit element. You should probably do the same thing in ICDS also. Because they are only talking about what will happen once you commence. They don't tell you what is going to happen prior to commencement. You could follow the same logic. So there's no need for any reconciliation there.
Oh, this is answered. SSC is an individual carrying on the business of dealing in shares, both futures, equity, commodity. Also, SSC is maintaining cash system of accounting. SSC is valuing closing stock of inventory at cost regularly. My question is whether ICDS is applicable as far as valuation of inventory is concerned, and can the SSC continue to value stock of equity shares at cost?
ICDS is applicable. ICDS on 8 on securities will definitely be available. Because you're holding it as stock in trade. It will be applicable. Cost or fair value, whichever is lower, will have to be accounted for. ICDS is applicable. Yeah.
Yeah, I think the last question. What declaration has to be made if the company has sold the business between the balance sheet date and audit date, being violation of going concern?
Nothing to do with ICDS, so I won't answer that question. But no, but what's the question actually?
What declaration has to be made if the company has sold the business between the balance sheet date and audit date, being violation of going concern? This is the question, or do we need some clarity? Can you just type? The last question from Poonam.
The last question is saying company has sold
Clarity.
between balance sheet date and what signing data?
Yeah, in ICDS 1. She's talking about ICDS 1. Disclosures.
Why?
Is she saying that should we disclose anything? Her
Not
question
required.
should-
Why? ICDS as on 31st March. Now, why do you want to talk about that subsequently? It's event-based transfer. Do it after the event is over. That's all. You don't have to disclose it.
We are done. Thank you, sir. It was an excellent session. I request our regional council member, Geeta Madam, to come on the dais and, as a token of gratitude and respect, hands her with a token of appreciation. Thank you, ma'am. Thank you, sir. Thank you for taking out your time and in this busy schedule and enlightening our members and having a deliberated discussion. Thank you, everyone. We'll now break for lunch and get back at 2:30. We'll start the session on time, 2:30.